Ever feel like you're just stuck on this treadmill,
Mm.
working just to like keep up?
Mm-hmm.
Today we're diving into something completely different.
Yeah.
It's a philosophy. It's all about breaking free,
Mm.
financial independence, retire early,
Mm-hmm.
or fire reading.
Sorry.
I like where we're going, as the cool kids call it,
That's us.
because that's us now.
Yeah.
So it's about getting to a point where, work becomes a choice, not a necessity.
Right.
So think about it this way. You could be, sipping margaritas on a beach somewhere, or finally tackling that passion project you've always wanted to do.
Yes.
The choice is yours.
It's about reclaiming your time and really like designing a life that reflects what's important to you.
Absolutely. So our guide for this deep dive is The Simple Path to Wealth
Oh, yeah. Classic.
by J.L. Collins. And this book has a huge following in the FIRE community.
Mm.
Collins actually started as a blogger. It's like breaking down these really complex financial concepts into this easy to understand advice.
Right.
And then he put it all together into this book. And today we're going to unpack his key strategies, the mindset shifts
Love it.
that can help you achieve financial independence. We're going to start with something that's kind of out there.
Yeah.
Collins suggests that you aim for a 50% savings rate.
Okay, so I know 50% sounds like a lot,
Yeah.
especially, these days. But it's a goal.
Right.
It's not necessarily like where you have to start. Collins isn't saying you need to live like a monk or anything.
Right.
It's more about shifting your mindset away from like keeping up with the Joneses and more towards what actually matters to you.
So it's about being intentional with your spending
Yeah.
and making sure your money is actually like lining up with what you care about,
Absolutely.
not just mindlessly swiping that credit card.
Yeah, and this leads us to one of Collins's most, how do we say?
Juicy.
Juicy, yeah. One of his most intriguing concepts.
Okay.
FU money.
All right. That got my attention. I'm guessing this isn't about like yelling at your bank account.
No.
What is FU money?
I love it. So imagine having the financial security to just walk away from
Yeah.
anything that doesn't serve you. So that could be a dead-end job, a toxic relationship, really anything that diminishes your well-being.
Wow.
That's the power of FU money.
So it's not just about early retirement then.
No.
It's about having the power to make choices that are right for you, regardless of finances.
It's about reclaiming your autonomy.
I love that. So how do we actually build this FU fund?
Well, Collins advocates for a surprisingly simple approach. Low-cost index funds.
Index funds, I've heard of those, but aren't those kind of a bit passive?
Right.
I thought you'd be like picking stocks and really like
Day trading.
day trading to build wealth.
Yeah. That's a common misconception. Actually, what's really interesting is that index funds, which just track a specific market index, like the S&P 500, have historically outperformed actively managed funds over the long run.
So instead of trying to like time the market or pick individual stocks, we're basically just betting on the overall growth of the market.
Exactly. Think of it like this. The stock market is kind of like a roller coaster, right?
Yeah.
It's got its ups and its downs, but over time, it generally goes up. And index funds let you ride that upward trend without having to, predict every single twist and turn.
Right.
And the best part is they usually have way lower fees than actively managed funds.
That makes sense.
Right.
But the world of investing can still feel kind of intimidating.
Yeah.
Like, where do you even begin with index funds?
Well, Collins has you covered.
Okay.
With his 3-fund portfolio. It's exactly what it sounds like. You're dividing your investments between 3 broad market index funds.
Okay.
U.S. stock market, international stock market, and bond market.
So we're diversifying across different markets.
Yeah.
But what's the thinking behind each of these funds? I'm especially curious about the bond market fund.
Right.
It always seemed a little bit safe.
Yeah, well, bonds are actually super important to the equation. They're like the shock absorbers in your portfolio. They tend to be less volatile than stocks, so they provide stability and balance, especially when the market gets a little rocky.
So while the U.S. and international stock funds are designed for like that long-term growth, the bond fund is there to kind of cushion during market downturn.
Exactly. The 3-fund portfolio is all about balancing that risk and reward.
Right.
And it gives you a really solid foundation for long-term growth.
Mm-hmm.
And to give you an idea of how this all plays out in retirement, Collins introduces this concept of the safe withdrawal rate.
Ooh,
or
cool.
SWR for short.
Okay, so we've got our diversified portfolio.
Yep.
It's working for us. We hit our FI number.
Yeah.
It's time to finally ditch that 9 to 5.
Ooh.
What is this safe withdrawal rate all about? How much can we actually tap into without, ending up back on that treadmill.
Right. So the SWR is basically a guideline for how much you can withdraw from your portfolio each year without depleting your nest egg.
Okay.
Collins recommends a conservative 4% based on historical market data. So let's say you have $1 million invested. You could potentially withdraw $40,000 a year.
That's a number I can get behind. But what about when the market dips, which it inevitably does? It seems like withdrawing 4% when the market's down would really eat into your savings.
Right. Well, that's where discipline comes in.
Right.
Collins really emphasizes the importance of staying the course.
Yeah.
Even when things get a little turbulent,
Yeah.
Resist that urge to panic sell or try to time the market. Those are the moves that lead to mistakes.
Costly mistakes.
Yeah.
So it's like weathering a storm.
It is.
You batten down the hatches, you trust that the market will eventually recover, and just focus on the long game.
Exactly. And remember that 4% is a conservative starting point.
Okay.
As your portfolio grows and your expenses change, you can adjust your withdrawal rate accordingly.
All right. This is making a lot of sense. Collins really takes the mystery and the intimidation out of investing.
Yeah, I think so.
Wouldn't you say?
Yeah, he gives you a clear roadmap for achieving financial freedom.
Yeah.
And he just emphasizes simplicity, consistency, and that long-term perspective.
I love it. It's refreshing to hear a financial strategy that doesn't involve crazy algorithms or, risky bets.
Right.
But I still can't get over that 50% savings rate.
I know.
I mean, for a lot of people, that just feels completely out of reach.
Yeah, well, and it's important to remember that Collins isn't advocating for a one-size-fits-all approach.
Okay.
The 50% is an aspirational target. It's something to aim for. But what's really important is establishing a habit of saving consistently, whatever that percentage may be for you at this point in your life.
So it's about progress, not perfection.
Exactly.
Gradually increasing that savings rate as you gain more control over your finances.
Yes, and that's where things get really interesting. We're going to dive deeper into the psychology of saving.
Ooh.
And how small shifts in your mindset can lead to big changes in your financial future.
All right, listeners, we are just getting started. Grab your favorite beverage, get comfy, and we'll be right back to continue our deep dive into the simple path to wealth. So before the break, we were talking about that 50% savings goal.
Yeah.
And how it can sound a little daunting.
It does.
But you can start smaller and gradually, work your way up.
Right.
What are some practical tips for making that happen? It's so easy to just get caught up in that lifestyle creep and feel like you constantly need to be upgrading.
Yeah, it's all about being mindful of your spending habits.
Right.
And making conscious choices.
Yeah.
Collins talks about differentiating between needs and wants. You need food, you need shelter.
Right.
But that fancy new gadget,
Yeah.
that's probably a want.
It's about asking yourself, do I really need this, or am I just trying to keep up with the Joneses?
Exactly.
Right.
And sometimes it's about finding creative ways to enjoy life without, breaking the bank.
Yeah.
So potlucks with friends instead of those expensive dinners, exploring free local events instead of, those pricey concerts.
Yeah.
There are so many ways to have fun without overspending.
It's about being resourceful and finding joy in those simpler things.
Exactly.
But let's be honest, sometimes those wants are really tempting.
Oh, yeah.
How do you resist those impulse buys and stay focused on that bigger picture?
Well, one strategy Collins recommends is delaying gratification.
Okay.
So instead of immediately giving in to that urge to buy, give yourself a cooling off period.
Okay.
Wait a week or two, see if you still really want it.
Right.
You might be surprised at how often that desire just fades away.
That's such a good tip. It's like hitting the pause button before you make that purchase to really consider if it aligns with, your values, your financial goals.
Exactly.
Yeah.
And remember, every dollar you save is a dollar you can invest in your future freedom.
Love it.
Speaking of investing, let's dive a little deeper into the mechanics of those index funds.
Yes. Let's talk about how to actually put our money to work.
Okay.
So we know index funds track specific market indices.
Right.
It's like a basket of stocks that represents a particular segment of the market.
Yeah.
But how do you choose the right index funds for your portfolio?
Collins suggests keeping it simple and sticking with these broad market index funds that cover a wide range of companies.
Okay.
So, for example, instead of trying to pick individual stocks within the U.S. market, you could just invest in a total U.S. stock market index fund.
So rather than trying to be like the next Warren Buffett,
Right.
we're basically spreading our bets across the entire market.
Exactly. And this diversification is key to mitigating risk.
Got it.
By owning a small piece of, hundreds or even thousands of companies, you're less vulnerable to the ups and downs of any single stock.
Don't put all your eggs in one basket.
Exactly.
I've heard that one.
But I'm curious, what are some specific index funds that Collins actually recommends?
Yeah, for each of those categories. U.S. stock market, international stock market, and bond market.
Okay, so for the U.S. stock market, a great one is the Vanguard Total Stock Market Index Fund.
Okay.
VTSAX.
VTSAX. Got it.
It covers a wide range of large, mid-sized, and small U.S. companies, so it gives you a broad exposure to the U.S. economy.
So what about the international stock market? I imagine there are funds that cover companies from all over the world.
Absolutely.
Yeah.
One that Collins recommends is the Vanguard Total International Stock Market Index Fund.
Okay.
VTIAX.
VTIAX. Great. And this fund invests in companies from both developed and emerging markets all around the world.
So now we're expanding our reach beyond the U.S., tapping into growth in, Europe, Asia, other regions. And then we can't forget about the bond portion of the portfolio.
Right, the shock absorbers.
Yeah.
For that, Collins suggests the Vanguard Total Bond Market Index Fund.
Okay.
BND.
BND, okay.
This one covers a wide range of U.S. government and corporate bonds,
providing that stability and balance to your overall portfolio.
So we've got VTSAX for U.S. stocks, VTIX for international stocks, and BND for bonds.
Yep.
That's our three-fund portfolio.
There you go.
Simple, diversified, designed for the long term.
Exactly. But remember, investing isn't just a set it and forget it thing. It's important to periodically rebalance your portfolio.
What does that mean, rebalancing?
So over time, your investments grow at different rates, right? And your portfolio might drift away from your initial target allocation.
Okay.
So rebalancing basically involves selling some of your better performing assets and buying more of the underperforming ones to bring your portfolio back into alignment.
So for example, if the U.S. stock market has like a really great year and your U.S. stock allocation goes up to like 60%, while your bond allocation shrinks down to 10%, you would sell some of your U.S. stock holdings and buy more bonds to bring it back to that desired allocation.
Exactly.
Okay.
Rebalancing helps you manage risk and maintain that desired level of exposure to different asset classes.
Rebalancing sounds super important.
Yeah.
But how often should you be doing it? Is this like a monthly thing, quarterly?
Well, there's no one right answer to that.
Okay.
Some investors rebalance annually. Others only rebalance when their asset allocation drifts significantly from their target.
Okay.
It really depends on your preferences.
Got it.
And how much effort you want to put into managing your portfolio.
So it's about finding that balance between staying on top of your investments without getting like too bogged down in those daily market fluctuations.
Exactly. Remember, the key to successful investing is consistency and patience. Stick with your plan, ride out those inevitable market ups and downs, and let that compound growth work its magic.
I love it. This is all starting to click.
Good.
But I am curious about that 4% safe withdrawal rate we talked about earlier.
Yeah.
How does that actually play out in real life? Can you give us some examples of how that might translate into income during retirement?
Okay, so let's imagine you've hit your FI number and you have a portfolio of $1 million.
$1 million.
Using that 4% SWR, you could potentially withdraw $40,000 per year.
Okay.
Without, jeopardizing your long-term financial security.
So $40,000 a year to cover living expenses, travel, hobbies, all the things you want to do in retirement.
Right.
But what if your expenses are higher than that?
Right.
What if you need $50,000 or $60,000 to live comfortably?
Well, that's where it becomes important to either adjust your savings goals or consider part-time work or side hustles to supplement those withdrawals.
Okay.
Remember that 4% SWR is a conservative guideline based on historical market data. You may find that you can actually safely withdraw a slightly higher percentage, especially if you're flexible with your spending.
So it's about finding that right balance between enjoying your freedom and making sure that your money lasts as long as you need it.
Exactly.
This has been incredibly insightful.
I'm glad.
We've covered a lot of ground, from building a savings habit to diversifying your investments to understanding the safe withdrawal rate.
It's a lot.
But what about the mental game of achieving financial independence?
Yeah.
We've talked about the practical steps, but what about the mindset shifts that are needed to actually reach these goals?
That's a really crucial aspect of the journey and one that Collins addresses in depth.
Okay.
We're going to explore those mindset shifts.
I love it.
And how to overcome those psychological barriers that often hold people back from actually achieving financial freedom.
We're about to dive deep into the psychology of money, folks.
I'm excited.
Don't go anywhere. We'll be back in a flash to unpack all these fascinating concepts. All right, so we're back. And, sometimes I think the biggest obstacles to financial freedom aren't spreadsheets or interest rates.
Right.
It's the beliefs we carry around about money.
Absolutely.
What are some of those mental hurdles that can really trip people up on this path to fire?
Well, Collins talks about how we inherit these limiting beliefs about wealth.
Yeah.
Maybe from our upbringing or from, just society's messages about money being greedy or evil.
It's like we've got these invisible scripts running in the background telling us we're not worthy or it's somehow out of reach.
Exactly. And these beliefs can be incredibly powerful, shaping our financial decisions without us even realizing it.
So it's not just about changing our spending habits. It's about really examining those deep-seated beliefs and reframing them into something that actually supports our goals.
So instead of saying I'll never be rich, try shifting to I'm learning to manage my money effectively and create abundance.
That's a good one. I like that. That's a powerful shift.
And speaking of powerful tools, Collins is a huge advocate for visualization.
Okay.
He really encourages readers to imagine themselves living their dream life as if they've already achieved financial independence.
So it's not just daydreaming.
No.
It's about actively engaging with it all your senses.
Yeah, feeling it, picturing those experiences.
Yeah.
Visualization can really help align your subconscious mind with your conscious goals, making it more likely that you'll attract the opportunities and resources to support those goals.
It's like setting your internal GPS for financial freedom.
I love that analogy.
Programming your mind to seek out those paths that lead to abundance.
It's about creating that clear vision of your future and then taking steps each day to bring it to life.
Okay. I am sold on visualization.
Good.
But let's be realistic.
Okay.
Even with the best intentions and a positive mindset, sticking to a long-term plan can be really tough.
Oh, yeah.
Life happens, temptations pop up.
Right.
It's easy to get sidetracked.
Well, this is where Collins emphasizes remembering your why.
Yeah.
Why are you pursuing financial independence? What are you going to do with all that freedom? Connect with that vision regularly, and it'll fuel your motivation.
It's like that North Star
It is.
guiding light to keep you on course, even when you encounter those obstacles.
Exactly.
Yeah.
What are some other ways to stay motivated on this journey?
Oh, there's got to be tons.
Well, one thing is celebrating those milestones.
Yeah.
Acknowledge your progress no matter how small it might seem. Those little wins can have a huge impact on your motivation.
It's about acknowledging those victories along the way.
Yes.
Maybe you paid off a credit card or hit a savings goal you set for yourself.
Right?
Take time to celebrate that.
Absolutely. And don't underestimate the power of community.
Oh, yeah.
Surround yourself with like-minded people who are also on the path to financial independence. Share your experiences, support each other, learn from each other's journeys.
It's like having that support system.
Yeah.
A group of people who get it.
Exactly.
And can cheer you on when things get tough.
And there are so many online communities and resources dedicated to FIRE. Find a group that resonates with you.
Okay.
And connect with others who are on the same path.
This has been an awesome deep dive into the simple path to wealth.
It has.
We've explored practical strategies, for saving, investing, managing your money, and then all those crucial mindset shifts that you need to create lasting financial freedom.
Yeah. It's been a pleasure sharing these insights with you.
Absolutely.
Remember, financial independence is a journey.
Yeah.
It's not a destination.
It's about making those conscious choices every day that are lining up with your values and goals.
Exactly. And it's about recognizing that you have the power to design a life that you love, a life where your finances support your dreams, not dictate your choices.
I love that.
Yeah.
So as we wrap up here, we want to leave you with this final thought.
Okay.
What is one small step you can take today to move closer to your financial goals? Maybe it's creating a budget, opening an investment account, or even just visualizing yourself living that dream life.
Love it.
The key is to start taking action.
Every journey starts with a single step.
Yeah.
Take that step today.
Live it.
And keep moving forward.
Until next time, keep exploring, keep learning, and keep diving deep